Iron Condor and Iron Butterfly. No, they are not Marvel villains, but they are just genius strategies for when the market does absolutely nothing. And trust me, doing nothing has never looked this smart. Hi, I am Pranav VK, your options trading guide here at Stockshaala by Kotak Securities. In the two previous videos, we learnt about short strangle as well as short straddle, and both of them had unlimited loss potential. But what if we could add two more legs to this strategy and make it limited loss potential, wherein that will give you a lot of peace of mind. So both the strategies, short Iron Condor as well as short Iron Butterfly, in simple terms, I'm going to name it as Iron Condor as well as Iron Butterfly for the rest of this video, is going to have 4 option legs. They earn premium when the market is in range-bound condition. The profits are capped, but so is the losses. Isn't that smart risk management? This is best for sideways markets, and some professional traders even use it for weekly expiries. So now let's look at the payoff diagram of an Iron Condor to understand the entire concept of an Iron Condor, right? To start with, we have profit and loss on the y-axis and the possible strikes on the x-axis. Here we remember that in a short strangle, we had 2 different strikes. One is out of the money call option as well as one is out of the money put option that we have sold, right? So here in this case, 19,600 is the call option at premium of rupees 30 and 19,400 is the put option at premium rupees 35. So when we did that, we had this kind of a payoff diagram without this maximum loss, right? So we had an unlimited loss potential which extended on either sides. But what additional features have we added here is that we have bought 2 different strikes. One is 19,700 call option, which is again further out of the money call option, and we've also bought 19,300 PE, which is further out of the money put option with a lower premiums. So when we added these 2 positions, there was a maximum loss that was capped, right? So the maximum loss is now capped instead of unlimited loss potential. So this combination of a strangle along with these 2 positions creates something called as an Iron Condor. So that this entire strategy is a net credit strategy. So if you look at the total credit, so here we received 35 rupees premium, 30 rupees premium, but when we are buying, we are paying 15 rupees and 20 rupees. So the total is plus 30, which is also our maximum profit for this specific strategy. Now that we know the maximum profit in this case, now let's also calculate the maximum losses. The maximum loss is nothing but the difference in strikes minus the net credit. So difference in strikes in this case is for call option, it is 19,700 minus 19,600, that is rupees 100, minus the net credit is 30, that is 30. So 100 minus 30 is rupees 70. So this is the maximum loss on the call option side. While on the put option side, it is 19,400 minus 19,300. Again, the difference is 100 rupees minus the net credit, again 30 rupees. So the maximum loss in this case on either side is rupees 70 for this specific example. While understanding this concept and knowing these mathematics are important, I would also like to share a quick hack. If you want to know the break-even points as well as the maximum profit, maximum loss, probability and all these variations, then what I would recommend is go to the trading platform where you're doing the options trading and go to the strategy builder and put these numbers, because that will give you instantly all these numbers clearly. Here is another simple way of understanding this payoff diagram. It is a combination of 2 strategies that we have already discussed in the past. One is a bull put spread, whereas the other one is a bear call spread. And when we combine these 2 strategies, we are going to get an Iron Condor. Let me show you how. This is the payoff diagram of a bull put spread, where you're going to make profits when the market is bullish, whereas this is the payoff diagram of a bear call spread. And when you combine these 2, this is what you're going to get. It is ideal to use a short Iron Condor when you expect the market to be in a range, as well as when the IV is high. Most importantly, you will be deploying this strategy when you want a defined risk and reward. Let's discuss the distant cousin of Iron Condor, that is Iron Butterfly, the tighter version of Iron Condor. Let's look at the payoff diagram of an Iron Butterfly so that we understand this concept in an easier fashion. So starting here in the payoff diagram, as usual, we have the profit and loss. Anything above the break-even point is a profit, below that is a loss. And this is very similar to a short straddle, but with limited loss potential. So how did we come to this? By using a 4-legged combination. We sold 19,500 call option as well as a put option, how we would have done in a short straddle. So the maximum profit is only at the apex, and as it comes near the break-even point, the profits starts reducing. And we also have bought 2 options, that is 19,600 call option as well as the 19,400 put option. So both of them are out of the money call as well as put options. Now here again, this is a net credit spread because we are selling higher premiums 50 and 55, which means we are receiving that much, and we are buying at 20 and 25, which means we are paying less. So overall the net credit of this strategy is rupees 60, and that is also our maximum profit. Now looking at the maximum loss calculation for this, the maximum loss calculation for this is done by the difference in strikes minus the net credit. So looking at the call option side, we have 19,600 minus 19,500, that is 100, minus the total credit is 60. So our maximum loss in this case is 40. Now let's also look at the put option side. Again, on the put option side, we have 19,500 minus 19,400, so that is 100 minus again the total credit, that is rupees 40. In case, let's say the put option had 19,300 instead of 19,400, then what would have been the case? So let's take an example for that. So in that case, it would have been 19,500 minus 19,300, that would have been 200 minus the net credit, that is 60. So the total loss in this case would have been rupees 140. Iron Butterfly is ideal to use when the market is absolutely flat and you are extremely clear about what is going to be the level at the end of expiry. And one other reason why you will go for a butterfly instead of a condor is when you want a higher premium compared to a condor. Condor might have maximum profit over a larger range, but it will have maximum profit lesser than what you would get in an iron butterfly. Just to show you that on the graph as well, an iron condor would end up being like this, where your maximum profit is capped here, whereas iron butterfly gives you this additional profit above and beyond an iron condor. So this is also one of the reasons why you would want to go for an iron butterfly. But as you can see, this higher profit also comes with the drawback that you need to absolutely be sure of the level where the market is going to end. Only then you're going to make this profit. Otherwise, it is better to go for an iron condor. It's time to compare iron condor versus iron butterfly on the various parameters. The first one is risk. Both the iron condor as well as the butterfly have limited risk because we have legs with buying on both the sides. When it comes to reward, condor has a limited profit potential, whereas butterfly has a little bit of a higher potential, but it comes with an asterisk. What it means is that you should be exactly clear on where the expiry is going to be, and only if the market ends at that specific level, then you're going to have that higher profit compared to a condor. Otherwise, condor is always a better option. And when it comes to the profit zone, here you have a wider range, whereas when it comes to a butterfly, it has a very narrow range where you're going to be profitable. And finally, the ideal market scenario for a condor is range bound, which means it could be within a specific range, wherein for a butterfly, it has to be very flat, which means a very narrow range, right? So be careful and wise while choosing whether to go for an iron condor or an iron butterfly. Here are a few practical tips while executing either of these strategies. Number 1, always check for high IVs. Since these are equivalent to option selling, we always want the IVs to be higher, and the IV crush is going to give us a lot of profit. Always make sure you're calculating the maximum profit, maximum loss, as well as the break-even points before entering into the strategy. Even though you have limited risk potential in these cases, I would highly recommend that you have proper position sizing as well as predetermined stop losses in your mind or on the chart. And finally, both these strategies are theta decay strategies, which means the more time you're in the market and the market is range bound, the more money you're going to make. So let's quickly summarize what we have learned so far. We understood that Iron Condor as well as Iron Butterfly are nothing but extensions of straddles as well as strangles, where we have limited risk potential. It is best to use both these strategies when the markets are sleeping and the premiums are rich with high IV. If you are excited with what you have learned so far, then stay tuned, because in the upcoming video we're going to change the game and we're going to learn about calendar spreads, where we're going to trade across times and use the power of volatility as well as time together. You're watching Stockshaala by Kotak Securities. I am Pranav VK and I'm going to see you in the next video. Don't forget to like, share and subscribe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.